Imagine planting a seed today and watching it grow into a strong, fruitful tree over the years. That's exactly what investing early can do for your financial future. By starting your investment journey sooner rather than later, you give your money more time to grow and compound. Even small amounts invested regularly can add up to significant wealth over time. In this video, we'll explore why investing early is one of the smartest financial decisions you can make, and how it can set you up for a secure and comfortable future. Let's start with the basics. What does it mean to invest? Investing is the act of putting your money into assets like stocks, bonds, or real estate, with the goal of growing your wealth over time. Unlike simply saving money in a bank account, investing allows your money to work for you by earning returns. The earlier you start, the more opportunities you have to benefit from market growth and compounding interest. Compounding is often called the eighth wonder of the world. It's the process where your investment earnings generate their own earnings. Over time, this snowball effect can turn small, regular investments into a substantial nest egg. The earlier you start, the more powerful compounding becomes because your money has more time to grow on itself. Time is one of the most important factors in investing. The longer your money stays invested, the more it can grow. Even if you start with a small amount, giving your investments decades to grow can make a huge difference. This is why starting early is so powerful. It gives your investments the time they need to reach their full potential. Let's look at two examples, Sarah and John. Sarah starts investing $100 a month at age 22, while John waits until he's 32 to do the same. Both invest the same amount each month, but Sarah's money has an extra 10 years to grow. By the time they both reach retirement, Sarah's investments are worth much more, all because she started earlier. Every year you wait to start investing can cost you thousands of dollars in lost growth. The earlier you begin, the less you need to invest each month to reach your goals. Waiting even a few years can make a big difference in your final investment value. Investing early helps you build strong financial habits. By making investing a regular part of your routine, you learn to prioritize your future and manage your money wisely. These habits can benefit you for a lifetime, not just financially, but also in terms of discipline and planning. Many people hesitate to invest because they're afraid of losing money or making mistakes. But starting early gives you time to learn and recover from any setbacks. The key is to start small, educate yourself, and stay consistent. Over time, your confidence will grow along with your investments. There are many ways to invest your money. Common options include stocks, bonds, mutual funds, and real estate. Each type of investment has its own risks and rewards, so it's important to do your research and choose what's right for you. Diversifying your investments can also help reduce risk. Stocks represent ownership in a company. When you buy a stock, you become a partial owner and can benefit from the company's growth. Stocks can be volatile, but over the long term, they have historically provided strong returns for investors. Bonds are loans you make to companies or governments. In return, you earn interest over time. Bonds are generally less risky than stocks, but they also tend to offer lower returns. Including bonds in your portfolio can help balance risk and provide steady income. Mutual funds pool money from many investors to buy a diversified mix of stocks, bonds, or other assets. They're managed by professionals and can be a great way for beginners to start investing without needing to pick individual stocks. Investing in real estate means buying property to earn rental income or profit from price increases. Real estate can be a solid long-term investment, but it often requires more money upfront and ongoing management. Diversification means spreading your investments across different types of assets. This helps reduce risk because if one investment performs poorly, others may do well. A well-diversified portfolio is key to long-term success. Before you start investing, it's important to set clear financial goals. Are you saving for retirement, a home, or your children's education? Knowing your goals helps you choose the right investments and stay motivated. You don't need a lot of money to start investing. Even small amounts invested regularly can grow significantly over time. The key is consistency. Make investing a habit, no matter how much you start with. One of the easiest ways to stay consistent is to automate your investments. Set up automatic transfers from your bank account to your investment account each month. This way, you won't forget or be tempted to skip a month. All investments come with some level of risk. Stocks can go up and down, and even bonds aren't completely risk-free. The important thing is to understand your risk tolerance and invest accordingly. Starting early gives you more time to recover from market downturns. Markets will always have ups and downs. The key to successful investing is to stay the course and not panic during downturns. Remember, investing is a long-term game. Staying invested through the highs and lows is how you build wealth. It's important to review your investments regularly. Make sure your portfolio still matches your goals and risk tolerance. Rebalancing from time to time can help keep your investments on track. Investment fees can eat into your returns over time. It's important to understand what fees you're paying and look for low-cost investment options. Even small differences in fees can add up to thousands of dollars over the years. Many countries offer special investment accounts with tax advantages, like IRAs or 401(k)s in the US. These accounts can help your money grow faster by reducing the taxes you pay on your investment gains. Before you start investing, make sure you have an emergency fund. This is money set aside for unexpected expenses, like car repairs or medical bills. Having an emergency fund means you won't have to sell your investments in a crisis. Many new investors make mistakes like chasing hot stocks, trying to time the market, or investing without a plan. The best approach is to stay disciplined, stick to your plan, and focus on the long term. You don't need to know everything to start investing. The most important thing is to begin. You'll learn more as you go, and your knowledge will grow along with your investments. There are plenty of resources available to help you on your journey. Investing isn't just about numbers, it's also about managing your emotions. Markets will go up and down, and it's normal to feel anxious at times. The key is to stay calm, stick to your plan, and remember your long-term goals. As you invest over the years, take time to celebrate your progress. Reaching savings goals, seeing your investments grow, or sticking to your plan are all achievements worth recognizing. These milestones can keep you motivated for the long haul. Once you've built good investing habits, consider sharing your knowledge with friends and family. Helping others start their investment journey can be rewarding and can strengthen your own understanding. Years from now, you'll be glad you started investing early. The decisions you make today can have a huge impact on your future. Your future self will thank you for taking action now and setting yourself up for success. The best time to start investing is now. No matter your age or income, taking the first step today can make all the difference. Remember, investing early is a gift you give to your future self. Start small, stay consistent, and watch your wealth grow over time.